Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close in a half hour's time. Let's get to the stories we're following in the BNN Bloomberg newsroom. The Prime Minister, Mark Carney, says he set out broad CUSMA parameters in a meeting with the U.S. President Donald Trump and Mexican leader Claudia Sheinbaum. And he adds Canada stands by its dairy supply management system. The Prime Minister responding to Washington's trade representative, who said a coming CUSMA review will hinge on resolving concerns about Canada's policies on dairy, alcohol, and digital services. Ottawa and Ontario have agreed to do one environmental assessment for a major project instead of two. Carney and the Ontario Premier Doug Ford signing an agreement to accelerate major projects, bringing them under a one project, one review approach. The agreement will help unlock the Ring of Fire. That's a mineral-rich region in northern Ontario. Ottawa has been pushing to develop resources and build projects more quickly. Confidence among Canadian small business owners has reached a three-year high. This is coming from the Canadian Federation of Independent Business. The confidence index now sitting just under 60%, and it climbed about 4% since November. The uptick surpasses numbers from May of 2022, which was around the time the Bank of Canada started to raise interest rates. The increased confidence is being pointed to as a sign that the economy is remaining resilient despite a volatile 2025. Shares of Lululemon trading higher after reports that activist investor Elliott Investment Management has built a stake of more than $1 billion in the retailer. Lululemon is currently facing a strategic overhaul and is looking for a replacement CEO who will the current CEO steps down in January. Elliott has been working with a former Ralph Lauren executive who is viewed as a potential CEO candidate. The TSX moving up 238 points so far on the day to 31,488. Let's have a look at the U.S. markets. The S&P 500 up 65 points today, almost 1%. The Dow Jones gaining 163 points, up about 0.3%. And the Nasdaq 348 points up right now. That's 1.5%. North American markets rebounded today with a tame inflation reading south of the border. Let's bring this to Wesley Blight, Vice President, Portfolio Manager at Scotiabank Global Asset Management. Thanks for joining us today.
Hi, thanks for having me.
So it looks like investors are heartened by the U.S. CPI data. Could this be the Santa Claus rally many expected?
We're pleased to see the news this morning. Lots of growing evidence of continued strength for sure. So happy with that.
Okay, so we still do have tariffs hanging over the economy. We're beginning to hear more from the U.S. about their expectations on trade with this country. Do you think this will be a continued drag for 2026?
I think it's going to continue to weigh on sentiment. We've seen a lot of change over the last year from Liberation Day and the surprise that we saw when that announcement came out. It weighed on sentiment significantly, and we saw a material drag across all capital markets. And then you can just look at what we've achieved since that point in time. Even though investor sentiment remained low through the summer months, economic growth has rebounded pretty significantly. We've seen really strong equity market performance. We've even seen strong bond market performance since that point in time. And all that's come through periods where investor sentiment has been really weak. We've seen weakness from both consumer sentiment and business sentiment. But at the end of the day, the performance has been really strong across capital markets from that point on. I think we're going to continue to see some rhetoric, and we're going to continue to see some news and headlines around the evolution of the trade policy as we work towards that potential rollover date in the middle of the summer next year. But our view is it isn't going to be all that disruptive to what transpires from a capital market perspective.
Okay, so how did you position to start the year, knowing Donald Trump was in office, knowing that tariffs were on the horizon? What was the focus?
So the vast majority of our performance is going to come from our strategic allocation. And there we spent a lot of time over the last couple of years updating our portfolios to add a little bit of equity exposure where we have the flexibility to do that. We have been adding in liquid alternatives. We've been adding in private assets as well, looking to achieve more robust performance. One of the other things that we've been doing within our portfolios is adding the flexibility to use tactical asset allocation. And within that context, we have increased our equity exposure a little bit as well. So looking to add some incremental value at the portfolio level by further participating in the equity gains that we've experienced. And that has largely played out really well, despite some of the news and headlines that we got around tariffs and the uncertainty that that was creating. So really happy with how that positioning has played out. From our perspective, a lot of the gains have been driven, obviously, from AI spending and AI-related spending. But we're starting to see some broadening out of earnings growth across the board. And that's not just in the US, it's in Canada, and it's global as well. From our view, we think that market concentration is one of the bigger risks that we are facing. What we're looking for there is, in the context of is capital expenditure still expanding, and is it expanding from the right base? So are companies refinancing themselves, looking to lean into more debt? That hasn't really happened in a broad-based manner as yet. Demand for data center usage is still really high. We saw that announcement come out from Micron earlier today, that underlying strength is still quite good. And then we're also looking at how are companies being able to deliver strong free cash flow while they're still keeping their CapEx high. And all of those signals right now, from our perspective, out the next 12 to 18 months are positive. So we're positioned with a modest overweight to equities as a result.
Okay, you mentioned the broadening out of tech and sort of the AI space. Have you done that this year? Have you repositioned sort of at the end of the year? Are you repositioning to take advantage of the broadening out?
We've already taken advantage of that opportunity by increasing our global exposure tactically to equity. So we'd already put that position on. We're really benefiting from that broadening out now. So that strong earnings growth that we saw predominantly coming out of the US mega cap names earlier in the year, and even in 2024, that broadening now is giving us the confidence to retain that overweight. And we're seeing the participation now expanding beyond just those select, highly concentrated names.
Do you think that next year will be the year we begin to find out or see the cracks or bigger cracks in that AI move, meaning the overspending and adding to debt, or a lack of value coming from the investments in spending on AI?
I think we might see some pockets of that. That's one of the key risks that we're focused on. But thus far, we haven't seen that showing up, and we don't anticipate that showing up in the immediate short term. Again, what we're looking for is, are companies still able to generate that strong free cash flow despite the high capex? And that is certainly playing out now. We're still seeing that broad strength from a free cash flow perspective. We're still seeing really high data center demand. There's a lot more of this story that has to be played out. Productivity is still expanding, we're growing. From that perspective, not really seeing a lot of challenges. But if we do get a disruption there, with the market concentration, specifically in the US, there is the potential for a little bit more volatility. There will be a knock-on impact, and that would be the point at which we might start to see some cracks, but we're not there yet.
Wesley Blight, got to leave it there, sir. I'm out of time, but thank you for your time. Appreciate it.
Thank you.
Coming up next, U.S. consumer prices rose less than expected in November, giving investors hope that inflationary pressures may be cooling. We're back in a moment. Consumer prices in the U.S. increased at an annual rate of 2.7% last month. The report was delayed by the U.S. government shutdown. But let's start there with Gennady Goldberg, head of U.S. rate strategy, TD Securities. Thanks for joining us today.
Thanks for having me.
How would you read the market take on the CPI data?
I would say highly confused. To be quite honest with you, there was a lot of quirks in the data. We didn't actually have October collections, so there was a lot of interpolation and extrapolation and kind of assumptions that were in the numbers that created a lot of knock-on effects for November. We're still really getting our heads around what that means. It is a better number. I mean, at the face value of it, inflation really decelerated during the month of November. We're going to give it a couple more months, at least one, possibly even two, for the data to really work off some of those significant disruptions. I don't think there's much to hang your hat on here, to be quite honest with you.
All right. Is that why you call it suspect? Because we don't have the numbers for October? Of course, they were canceled, the release canceled by the shutdown of Washington.
Yeah, it's hard to make too much hay out of this one particular number. It was wildly different from expectations. I mean, we're talking, half a percentage point basically off consensus market expectations. That's really difficult for markets to get their heads around. It's not because we're not thrilled that inflation could be coming down, but because some of the component by component changes don't seem to line up with what we've seen before. Rent inflation, for example, was a lot slower than anyone expected. A lot of that has to do with the way the BLS calculates these things. And when you don't have a month of collections, when the data set suddenly disappears, there's a lot of assumptions that are being made. So we are going to wait a little bit until the data is cleaner. Thankfully, we'll get one more reading of CPI, one more reading of payrolls, actually, ahead of the January FOMC report, FOMC meeting, and that's going to be quite helpful for markets.
Okay, on a wider lens, economists had predicted that the tariffs would increase inflation at this point of the year, but really that hasn't occurred. If you believe the numbers, the opposite has occurred. So how do you square that?
Well, heading into the shutdown, that is what was happening. We still expect tariffs to push inflation higher. You really have to think about it in three main components. Core goods, so that is the stuff that really is tariff impacted. Core services, excluding shelter, so that's really, kind of the cost of haircuts and things like that. And then housing. Now, housing's been a pretty positive story. It has been weighing on inflation overall. Core services hasn't seen that pass through from goods. The price of haircuts hasn't gone up because your barber's razors have become more expensive. That's the big worry for the Fed. You have been seeing it certainly in the core goods component. You've been seeing those tariff rates actually pushing inflation higher. Now, it really depends on how much more there is. Is this a delay, or is this, really tariffs not pushing those prices higher? We think there is a bit of a delay. We do expect inflation to peak higher than it is right now, early next year, probably at around 3.3% or so, give or take, and then actually come down by the end of next year to about 2.5%. We're obviously taking a close look at those numbers now that inflation's come out well below expectations. But I do think the next couple months are going to reveal what the trends are looking like on the tariff pass-through.
Okay, let's talk about the 10-year yield at about 4%, even as the Federal Reserve cut the rate. What does that tell you about investor concern?
I think investors are kind of stuck between a rock and a hard place. They are seeing the labor market gradually cool, but not cool sufficiently to actually create panic, which is great. But we're also not seeing inflation accelerate materially. We're not seeing it decelerate materially, except for obviously this 1 month. I think investors are still waiting for clarity. What this means is the Fed may not have sufficient clarity to cut rates at the January meeting. Not a lot of that is priced. There's only about 5 or 6 basis points penciled in by markets of a 25 basis point rate cut. There's substantially more penciled in for March. And I do still think that there is potential for the Fed to continue to cut interest rates. But, our view is 3 more rate cuts in 2023 six. We're expecting March, June, and September. And really, as those come in, the Fed will be kind of feeling their way around whether they need to cut rates further or they don't. And I think for investors, as long as there's a prospect of rate cuts on the horizon, rates can be relatively contained and can continue to drift lower.
Okay, so why do most think that there will not be a rate cut in January? And do you expect the December inflation information, if it continues that trend that seems to have started last month, to carry on, do you think that'll be the clarification they need?
I think the inflation data is going to be just one part of it. I think the labor market is going to be a huge chunk of what they actually really need to see. If we continue to see the labor market deteriorate, so let's say we get a significantly negative number, let's say the unemployment rate rises actually more than expected, maybe we go up to 4.7 or even 4.8, that could certainly open the door for a cut relatively soon. What the Fed did in their last statement was actually insert some language, basically making it unlikely that they continue to cut at every meeting. So it does seem like there is debate within the FOMC, pretty hefty debate about whether they should continue to cut rates at consecutive meetings, whether they should take pauses. The issue is we're getting into some FOMC members' expectations for where the neutral rate is. Remember, those run the full gamut from 2.5 all the way up to almost 4%. The deeper we cut rates here, the better, the more significant the fights get. Most of the committee, so around 70% of the FOMC, thinks the neutral rate is somewhere between 2.75 and 3.5. The closer we go to that, the more the fights are going to break out. So in our minds, they're just going to have to go a little bit slower to make sure that everyone's comfortable cutting rates to where they think they need to cut them.
Got it. All right, Gennady, got to leave it there. Thanks for joining us today.
Thanks for having me.
Up next, Lululemon about to see massive change for the new year as the company CEO steps down. More in a moment. There are reports today that Elliott Management has racked up a stake of over $1 billion in Lululemon. And the CEO, Calvin McDonald, recently announced he's stepping down. So we got more from David Schwartz, equity analyst at Morningstar.
Just last week, we were told that Calvin McDonald would be leaving the company at the end of January, and there was no succession plan in place. The company will be led by co-CEOs in the interim. But yes, as you mentioned this morning, we heard that Elliott, an activist hedge fund, which has been involved in other activist campaigns against companies like Southwest Airlines, has taken a large stake in Lululemon and has apparently been working with Jane Nielsen, who's a former CFO at Ralph Lauren, and before that at Coach, where she was very successful in turning both of those brands around. And apparently she may be a candidate to be the CEO of Lululemon after McDonald leaves. She would be a very strong candidate for CEO, given her success at both Coach and Ralph Lauren, two brands that were in worse shape than Lululemon is. But both of them have had tremendous turnarounds, and she was certainly part of that. Not the only person, of course, but she successfully reduced distribution of both of those brands and improved their brand health and their pricing. Ralph Lauren especially has been very successful over the last few years, whereas a few years ago it was actually in pretty poor shape.
A couple of questions. First up, with Elliott, how much sway would they have on being able to bring in a CEO that they would like to see? If this is true, of course, if this is actually the case, that they do have that $1 billion.
At this point, Elliott doesn't own enough stock to just demand a new CEO, so it would have to be approved by Lululemon's board. There's no indication at this point that Elliott is planning a proxy fight or anything like that, which would be very costly and time-consuming. There's also the issue that Chip Wilson, the founder of Lululemon, has also been vocal lately, which is nothing new from him. But he filed an updated 13D a few days ago, suggesting that he wanted to be involved in the CEO process as well. Whether that means he wants to go back to Lululemon or not, I don't know. I don't think so. For one thing, he's a big shareholder in Amer Sports, which could be considered a competitor to Lululemon. But Chip Wilson also seems to want to be involved in the CEO process. It looks like Elliott does as well. And I think the board would be very open to hiring Jane Nielsen if that is the choice, because of her strong background at Ralph Lauren and Coach. And before that, she was at PepsiCo.
I mean, today this is good for the stock. I'm looking; it's up about 5.6% almost. But will this be good a little longer, short term, and long term? If we see some battles shaping up between Wilson and Elliott, or any controversy with that?
I don't think that would be a good thing for Lululemon. Those fights are very expensive. I'm sure a lot of people remember the one at Gildan last year, which cost tens of millions of dollars. It did ultimately result in the CEO and founder coming back to the company, Glenn Chimandi, but it was very contentious for a long time. I don't think Lululemon wants something like that to happen. It's really not necessary at Lululemon, because Lululemon is still a strong company. It's just had some slowing growth in the U.S. and Canada recently, and that's been a concern for investors. And there have been some product issues, but I still think the Lululemon brand is very strong. This is a company that generates huge cash flow, is buying back a lot of stock, and I think the stock is undervalued. My fair value estimate is $295 a share. So I think Lululemon will be fine. There isn't anything really broken at the company. I still think the brand is very popular. And so I don't think there's any need for some contentious activist fight.
And if Nielsen were to come in as a CEO, what direction would you see her wanting to take it? Would she go high, like even higher end than Lululemon's kind of perceived as?
That's very possible. Certainly, some of their competitors, have thought about doing that to some degree. Alo Yoga seems to want to be more of a luxury brand more than an athleisure brand. They've been releasing handbags that cost several $1,000s. Lululemon could do more of that, but really, I think Lululemon is going to become more of a mainstream sportswear brand. There is an opportunity in sports like golf and tennis, where Lululemon has introduced some products, but it's still relatively early. And Lululemon has also made some moves into sponsoring athletes, as traditional sportswear companies like Nike and Adidas do. And I could see Lululemon, becoming a bigger player in sportswear. There's also the footwear market, which Lululemon has got involved in a little bit, but it's still very small. But that's a big potential opportunity for the company. So I still think there's a lot of growth opportunities for Lululemon, both in sportswear, but maybe also in luxury too.
David Schwartz, equity analyst, Morningstar. Let's take a last look at the markets before the end of the trading day. The TSX has moved up today after starting the week down. It's up 179 points so far at 31,428.6% up. And a quick look across the border at the S&P 500 and the NASDAQ, everything in the green so far. We're back with the end of day numbers in just a moment. It's the end of the trading day. Here are the closing bells. At the NASDAQ, Cardinal Infrastructure ringing the bell. In New York, the Bowery Mission ringing the closing bells. You're watching The Close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX gaining 190 points today, up 0.6% to 31,440. The S&P also in the green today, a 53-point gain, up about 0.8%. The NASDAQ moving up as well, a 313-point move, 1.4%, taking the NASDAQ above 23,000 to 23,006. Let's get to the movers in Toronto. NFI Group moving up today over 7%, so $1.04 per share price, taking it to $15.50. NGEx Minerals also moving up today. It moved up 4.3%. That's a gain of $1.06 per share, taking it to $26.02. It's up 110% in the last year. In the red is Curaleaf Holdings, dropping 32%, but it's been gaining quite a bit the last few days. It dropped $2.08, taking shares to $4.41, still up, though, 90% on the year. And then BRP dropping today as well, down 5.56, $5.56 to 98.44. That's a 5.4% drop for BRP. And in the U.S., Micron moving up over 11%, closer to 12 today after it reported earnings yesterday. They gained $26.70 a share, taking each share to $252.11, and it's up 132% in the last year. So markets in the green today, supported by lower than expected inflation data in the U.S., which improved the outlook for lower interest rates next year. Let's go to Cameron Scrivens, President, Portfolio Manager at JCIC Asset Management. Thanks for joining us today.
Nice to see you.
Without the CPI data for October, that release was canceled, and so we don't have the comparison. What's your take on the November data?
So the November data looked good, but we got some missing information. The BLS workers were not allowed to go collect their prices, and so there's a lot of data missing from October. And so you're basically looking from a September to November number, so you got to smooth the numbers. And so I think we're viewing this as a one data point, and we're going to be really curious to see if it continues into December.
Did you have questions about specific sectors, for example? Where did you see some difference that made you raise your eyebrows?
Well, so we like seeing the fact that you did have some curious things, such as the cost of airline seats went down. You had housing, which is a big component of CPI, almost a third, was down. So you had some kind of different spots that were interesting, but it really is one of the reports I think I saw coming out of Ernst & Young basically called it the Swiss cheese report, and that's very, very accurate because there's a lot of holes in the data, and so it's really tough to get a real bead on whether inflation is softening or whether there's going to be another uptick in inflation and it continues to be sticky. And then that will make the Fed potentially stop their cuts. They started their first cut December 10th, and we'll be getting another report from the FOMC on January 28th.
Okay, let's broaden out. What kind of growth do you expect for the U.S. economy next year, and how much of an overhang do you see tariffs being, or will they be?
So I think you've seen most of the inventory has been probably shaken out of the system from people building up before the tariffs really started to kick in. We're looking at GDP growth probably around 2 to 2.5% into 2026. And we think that tariffs are going to be lapped in the middle of 26. So we are fairly constructive on growth into 26, and if you do get a little bit of support from the Fed with some rate cuts, then we think that we're fairly constructive on the equity markets.
Okay, so where are you investing or seeing investing opportunities right now?
So I think there's a lot of interesting opportunities for stocks which really didn't participate in the huge momentum in 2025. And I think you've got some interesting areas like healthcare, like utilities, like real estate, which have been poor performers. And then you even have some interesting names in the mega caps. I mean, if you take a name like an Amazon, it's only up 3% this year against an S&P of 15. So I think there still is a great opportunity for a stock like Amazon.
You also like General Electric based on sort of travel growth in certain markets. Tell me about that.
So General Electric has been a home run stock this year. They make jet engines, commercial jet engines, engines for military as well as servicing engines. So you've got a lot of interesting dynamics around the world. You've got countries like India, which has just under 20% of the global population, and they've only got less than 4% of the available seats for airplanes. So we think there's a huge opportunity for GE, especially in countries like India. And you're going to, they're not only going to be able to sell engines, but they're going to be able to service them. And in countries where the weather is very hot and you've got a certain amount of pollution, that wears the engines down faster, which means you're servicing them more frequently.
Okay, are you looking at anything outside of the U.S.?
We are. I mean, we do like Canada. We do like gold. We continue to think that the mineral mining space will be strong in 26. We are very favorable on international companies, especially in Europe. And Europe has been a challenging place to invest in the last 5 years, but it really had a strong year in 25.
All right, I will leave it there. Cameron, appreciate your time. Thanks for joining us. Cameron is President Portfolio Manager, JCIC Asset Management. After the break, we'll get a Bay Street veteran's thoughts on the Anglo tech deal. Back in a moment. A Bay Street veteran says he wasn't surprised that Industry Minister Melanie Joly did not get much more out of Anglo American once its deal with Teck Resources was announced. We got more from Thomas Caldwell, Chairman, CEO, Caldwell Securities.
Governments try to, I think I used the quote a neighbor of mine once said, governments are like a giant trying to catch up with a sprinter. The business case is they're going to give governments what they need or what they need for optics to make everybody look happy. And for them to say, oh, well, we got something, I really got a deal and I protected Canada. No, the long and short of it is Canadian companies are all taken over by foreigners. That's a bigger issue. In terms of what you managed to grasp out of this deal, it's like dancing on the head of a pin. Mm-hmm. Oh, they're going to have this people and that person there and they can't lay off this stuff. Remember, it's like the old days where offices had to be in Montreal versus Toronto, the banks, etc. Well, you know, it looks like a duck, but it's not. The offices, the power is here. Doesn't matter where your legal head office is. So it's really about political optics, period.
I mean, their headquarters is moving to Vancouver, and executives will spend a major amount of time in this country. Does that mean Canada wants something of a victory here?
Well, whatever you can glean out of a deal like this is a win. What really is important, if you have big mining interests in Canada, which indeed they do, then executives are going to spend a little bit more time here. I don't think they're going to really be selling their homes in London or thereabouts and relocating the real decision-making. In any corporation, doesn't matter how big it is, 4 or 5 people run the company. So of those 4 or 5 people, you're going to have 1 or 2 of them popping by Vancouver, maybe 1 or 2 living here. But the center of power is still going to be based out of London because their geographical interests are so widespread. And London has not only expertise, but also time advantage in terms of connecting with the rest of the world. So, yeah, everybody's saying they've won a victory here. But in actual fact, it's a major integrated Canadian mining company being taken over by a foreign mining company, just like Inco, Noranda, Falconbridge, all of these, they're all gone. And head offices are very important, but head offices in fact, as opposed to head offices in optics. And as you know, governments work in optics.
Yeah, that's true. And they didn't even move their legal domicile to this country. And that seems to be a sticking point, but Anglo wouldn't give in on it.
I think that would be far too complex to do. So governments, I look at this as as the continuation or the end game of a bad situation, the sellout of corporate Canada. So they're trying to put as good a face on it as they can. And Ms. Joly is, you know, she's part of the Trudeau entourage, and she's very well schooled in making things look good. But in actual fact, we are losing control of our head offices. And head offices are, I mean, real head offices are critically important to the development of country.
one commentator telling the Globe and Mail that, well, Canada got legal undertakings from Anglo here so they can launch legal action. But I don't know. I mean, so you sue them and it drags on for years. And is that really going to change Anglo's behavior?
Absolutely not. It's about appearances. The head offices are very. I had a debate with the head of the Rotman School, Roger Martin, years ago about head offices, and he said, "Well, we got to check the." I said, "If we take an airplane and fly around New York, you'll see a major concentration of head offices, major charities, major universities, major giving, tremendous wealth, and we'll fly around Sudbury and see some head frames." What's more important, the head offices, are they important? Indeed they are, but head offices in substance. But I still think you have a lot of Canadian companies that have their theoretical head offices still in Montreal. Now, Air Canada and CN, of course, they're pretty well stuck there. But the rest of them, in fact, it's Toronto. And that'll be, in fact, Anglo-American will still be in London. They will have interest in Vancouver. Don't get me wrong. They will have interest because they have mining properties there. But of those 4 or 5 people that run every major corporation, you're not going to see 4 or 5 people moving to Vancouver. Those 4 or 5 people.
It's interesting you mentioned Sudbury. I mean, people love living there, but when you consider the billions of dollars of mineral wealth that, extracted over the decades, I don't see big, magnificent skyscrapers in Sudbury.
Well, it's a production town, and Sudbury. People in northern Canada, northern Ontario, they love it. They love it. The quality of life and the people and the culture. I mean, it's got to beat Toronto, doesn't it, Andrew? but it is a little bit of a harsh world, and theoretically, managers want to stay where banking, accounting, legal advice is concentrated. And to date, that's been Toronto. Well, that is diffusing somewhat, but you still have to be where you can get that corporate type of input. So it's a production town, and it's come along really well. When I used to cover accounts up in Sudbury, it was like the face of the moon. So it has improved, but it's still a production town.
They did clean up the air. That's right. Thomas, leave us with a final thought, though. Should we in Canada be much more aggressive about just hanging on to our companies and simply saying no to these foreign takeovers?
Andrew, I take it one step further. We got to think and dream bigger. And I'm not just blaming governments and regulation and constraints and indigenous rights and all this stuff. It's also managements. Why aren't we the takeoverers versus the takeoverees when it comes to resources? We are a mining giant as a country. Why aren't we using this to expand around the world and take that expertise around the world?
What is it a timidity, a laziness in Canadian business culture, Thomas?
I don't know that there's a word. It can be timidity, it can be laziness, it can be incompetence, it can be a whole bunch of things. Your head offices tend to gravitate where your capital markets are, and our capital markets, of course, have been dissipated in Canada massively. So you're not funding new companies having head offices here. There's a whole bunch of reasons for it. But I would challenge managements to think beyond being branch plant managers as opposed to being aggressive mining titans, if you will.
Thomas Caldwell, Chairman, CEO, Caldwell Securities. Nike reports earnings, and those numbers are just coming in. Investors looking for signs of that turnaround that has been promised. We'll take a look when we come back. Nike releasing second quarter results that are coming into the newsroom now. Revenue up for Nike at $12.43 billion, so a slight increase year over year. And the estimate for the company had been $12.24 billion. That was the Bloomberg consensus. So a beat for Nike on revenue. Direct revenue coming in at $4.6 billion, but that's an 8% drop from last year. The estimate had been actually higher for $4.75 billion. Wholesale revenue coming in stronger at $7.5 billion, so 8.7% increase year over year, and the estimate at $7.12 billion. And then Nike brand digital sales down 14% versus down 21% year over year. So a better number, but still losses there. Earnings per share coming in at 53 cents. Let's get into the numbers with Jessica Ramirez, co-founder, managing director at the Consumer Collective. Thanks for joining us today.
Hi, thank you for having me.
We want to outline for viewers, of course, that Nike has been trying to turn things around. The brand has really suffered in the past couple of years, and they're kind of mid-step in this revolution that they're trying to start. What's your take on the numbers?
The numbers, I feel it's a mixed bag from what we can see. Wholesale is clearly something that they've been focusing on during this turnaround, and again, early stages, as you've pointed out, it's midway. DTC is still lagging, though there was some improvements year over year, but it's still a bit of a concern. They have one space back in terms of running. Running has done quite well for them, so I expect them to talk quite a lot about that. But again, I'm still much more concerned about the lifestyle sneakers, which do make a large part of that business. And again, if I think of the decrease in DTC while performance is doing better as it should, and that has been their focus, there is some still lags on the majority of the business.
Okay, when you think of the company historically, what did you associate Nike with, whether it be a sport, whether it be an icon? What did you associate the company with?
I think if I think back to its heyday under Mark Parker, there was everywhere you walked, everywhere you got on a train, if it was in a big city, everyone was wearing Nike, and it could have varied from what sort of style there was of Nike. Again, that's where I think about the importance of their lifestyle platform that they had. And at that point, it was the Air Max platform, and that did fantastic. Sport did very well for them at that point. Then, we kind of came into this infliction of Donahue, where it was focused on digital, but it was much more on the numbers, and it kind of really lost the essence of what a performance brand, what a sports brand really represents. And we had all these new brands come in. So On has done extremely well and is doing very well. They're really becoming a lifestyle brand, and it's showing in their numbers. Hoka had been doing really well. It's doing decently. Then you had New Balance do a turnaround. You have Asics. You have all these other brands that started taking in their market share. And again, Nike is one of the largest companies at retail as a brand and in the market. But again, share has been taken from them from, what I feel is a snooze that they had under a previous CEO, where I feel under this CEO, performance is right and center, again, as it should be. But I think there are some parts that should not be lagging and also need to be equally taken care of.
I don't think we've seen the information yet, and more might come up on an investor's call. But I'm wondering about inventory, because they had a huge inventory that they had to sort of get rid of as a way of being able to focus on the future. Do we know if they've been able to do that?
Yeah, so I do quite a lot of store checks and channel checks, and a lot of that offloading that they were doing earlier this year, they were going to do that through their factory stores and also off price. At one point, I did see quite a lot of sneakers through off price. In recent checks in the past 2 months, that really has decreased. So I do think that they have been able to manage through that. I think where we still see the issue at is at Foot Locker. And that has been really the priority, to offload a lot of the dunks that Foot Locker inherited. And from the recent Dick's earnings call, they did mention they were working towards getting rid of all that Foot Locker excess of Nike to start the year fresh. So I think that's something being worked on and has successfully been worked on.
One of the other challenges for this company and many other companies, but hitting this company a little bit harder because of where it is and where it makes its running shoes, is tariffs, right? They're talking about a $1 to $1.5 billion hit from tariffs. Have they been able to work that through? Can they change production or manufacturing somewhere else? I mean, how are they taking that challenge on?
Yeah, so given the size and the magnitude of this brand, it is quite hard to switch everything over. Vietnam has been quite a key center for them in terms of production. They have taken the hit. We have seen price increases. They've been very transparent about the price increases. What I have really seen is, as they've brought new sneakers on in terms of running, in terms of, again, some lifestyle ones. If I think of the Shocks, if I think of the LD 1000, SNDR, these sneakers have come in at a much higher price point than we would have seen in previous, when they bring out a new sneaker. So that's one way that they have handled it. Again, I think Nike, being the brand and the massive push that they've done on marketing, is a way of them justifying their price points and what the brand stands for in general in today's consumers' eyes. But to kind of really counter that, I'd say within the sneaker market, everyone's done the price hike. So I think the consumer is just kind of stuck between, a high price at On, a high price at Nike.
Yeah. What about partnerships? Because we know for a lot of leisure wear, especially shoes, what matters is who's wearing them. Have they drummed up new partners? Are they putting their shoes on people they should be putting their shoes on to get the awareness they want to get?
I think in terms of performance, they have done that. Again, we've seen a lot in terms of soccer. We have the World Cup next year here in North America. That's been really drumming up. They've done very well with in terms of that. Again, I think where my criticism heavily lies in is, again, the lifestyle part, and that's where they've lacked, where, again, we've seen that before, and that tends to be a big bulk of the business. So if I refer to the Shocks, that sneaker was relaunched or resurfaced about a year ago, a year and a half ago, and it started taking off well in different parts of the world, but it never had that full push. Again, having an ambassador, having it on more people's feet and influencing it that way. Again, heavy marketing. So I feel, again, that's sort of the miss, where we've seen much more marketing or more of these lifestyle sneakers take on, and even in the resale world, take on from ASICS. ASICS has done fantastic. If I think of Tiger as well, has done fantastic. So there's some other brands that I think are still taking part of their heat.
Jessica, I'm going to leave it there. I'm out of time. Jessica Ramirez, co-founder, managing director at the Consumer Collective. Thanks for that.
Thank you.
Coming up next, the Prime Minister and the Ontario Premier announced a new agreement to streamline some major projects. Back in a moment. The Prime Minister and the Ontario Premier have announced cooperation on the Ring of Fire. It's an area in northern Ontario believed to be rich in critical minerals, but one that needs billions of dollars in development to gain access to the resources.
This agreement will speed up project approval timelines by introducing a new one project, one review approach. And under the agreement, Canada and Ontario will have a streamlined and flexible assessment process that will make approvals more efficient, delivering major projects faster while maintaining both federal and provincial standards.
All right, so this means assessments won't be duplicated in an effort to fast-track the process. Let's go to Evan Pivnik, Program Manager at Clean Energy Canada, to discuss this. Evan, do you mind first telling us what Clean Energy Canada does?
Yeah, thanks for having me on. Clean Energy Canada is a national think tank here in Canada, works with provinces and the federal government to inform how Canada can best navigate the energy transition and advance climate policy in the country.
Okay. Do you believe the kind of cooperation we heard about today will actually speed up the process, first, of building roads to the area?
Yeah, I think in general, today's announcement certainly has positive prospects for projects in the Ring of Fire, but it's also more general right across Ontario. Duplicative processes create a lot of uncertainty, a lot of time, and cost a lot of money. It's definitely an area that industry has highlighted consistently in Canada, with two levels of government that can play a role in providing assessments and in having responsibilities under Constitution for different pieces, that if they're doing the same things, that's just adding cost. So the ability to work together across jurisdictions is absolutely vital to see some of these projects move forward faster.
How different are the environmental assessments that they do at the federal level versus the provincial level?
It really depends on the different aspects. So both have constitutional responsibilities for different aspects, but in the Canadian Constitution, there's also a lot of overlap in certain areas. And so that's where you can end up with duplicative processes where it's the same thing being assessed using slightly different requirements, different reporting. At times, it can be you need to actually do two separate studies, or by the time you arrived at the process for one government, the study you had conducted for the previous government has already expired in terms of its recognition. These are the sorts of things that having one process where there's coordination between governments, where they essentially want the same information, can just be allowed to be streamlined rather than just creating that sort of overlap and longer timeline.
Do you feel confident then that one process over two will do a thorough job?
There's no reason to think that one process over two won't do a thorough job if it's followed through and thoughtfully implemented. industry doesn't want bad reviews. And at the end of the day, what we should be looking for is good projects that can actually get through not just environmental assessments, but also meet that threshold of consulting with Indigenous nations and thoroughly engaging them through the process. There's no certainty for a company if the process then is undermined and they end up in court because of another group says that they fail to review or uphold or follow through on something that's constitutionally required. So there's the duplication was not necessarily creating better outcomes on different projects. It'll come down to the actual way in which, and in this case, a lot of responsibility on the province of Ontario to design and implement thorough and thoughtful environmental assessment processes for projects.
With regards to the roads being built to the Northern Ontario Ring of Fire, 2 Indigenous groups are leading assessments, but there's opposition from other Indigenous groups to building those roads. So is it clear how that will be dealt with?
Yeah, with the environmental assessment processes themselves, those have to do with the engagement of and then the different details for. Governments have a responsibility to consult, engage with, and build in to these processes Indigenous rights and title where they exist. That is going to be responsibility heavily on governments for each of these individual projects. I wouldn't say this provides clarity of exactly how that will be moved through, but it does create one table, one process where some of those conversations can then take place.
Okay, so what is your bigger take on the project? The Ring of Fire has been discussed in the province of Ontario for decades, and the challenge has always been the amount of money and physical effort it will take to get that infrastructure built. If they can get it done and if they can get it fast-tracked, what is your big take on this project?
Yeah, at the end of the day, the environmental assessment is one aspect of this. And again, the ability to identify and move forward with good projects that do not have that can navigate the environmental impacts that they will have. That's what this allows for. And it provides some ability to move forward in a more streamlined way, which will help investors, which will help create certainty, which will help move forward potentially on some of these processes. But there's still a lot of technical challenges and there's still a lot of impacts to consider. So you're building roads that need to go through peat moss that at times are truly floating roads. That's a technical challenge as much as an environmental one. You've got, as you've said, big costs and long distances to also build out other infrastructure, electricity, to ensure these mines can be powered. This opens up, this helps move one hurdle out of the way. It definitely does not guarantee projects here. In general, Ring of Fire, there's a number of regions in the province that offer opportunities to expand critical minerals. And for both Ontario and the government of Canada, that's a really essential industry. It offers opportunities to position Canada as a clean energy superpower, meeting not only its own needs for critical minerals that are, just exploding in demand with the energy transition, but look for opportunities to export to a wider array of countries. And so this has as much to do with trade diversification as anything else.
Yeah. Evan Pivnik, got to leave it there, sir, but thanks for your time.
Thank you so much.
Coming up, the Trump administration's latest tariff demands and how they could impact Canadian dairy farmers. More in a moment. Courier company FedEx reporting earnings after the end of the trading day as well. Here is what they had to say. Adjusted earnings per share for FedEx coming in at $4.82 versus $4.05 last year. So that is up. And the estimate had been for $4.12. So $4.82 definitely a beat for FedEx. Revenue coming in at $23.5 billion. That's almost a 7% increase year over year. And the estimate had been for $22.8 billion. So again, another beat for FedEx in revenue. And FedEx raising the low end of its full year profit and sales outlook, signaling efforts to slash cost and streamline delivery are bearing some fruit. And FedEx undertaking a massive restructuring of its delivery network, merging its ground and air cargo systems, a plan the company estimates will produce $1 billion in permanent cost reductions next year. So after radio silence for weeks, we're now getting an idea of what the U.S. wants in a trade deal renegotiation. One asks more access for American dairy products in the Canadian market. It's been a sore point with the U.S. for years. Let's start there with Tyler McCann. He's managing director at the Canadian Agri-Food Policy Institute. Thanks for joining us today.
Thank you for having me on.
Canada has always been very protective of the dairy industry. Do you see an opening for negotiation here?
Yeah, I think it's important to put Canada's protection in the dairy industry in context. The U.S. is very protective as well, but what the U.S. is really asking for, and what we heard from the U.S. Trade Representative is, can we fix how we administer our dairy tariff rate quotas? These are quotas that were agreed to as part of the original CUSMA agreement. They don't like how we are administering them. They also don't like that we won a dispute panel over that administration in 2023, and so they're hoping that we can fix them. And I think that there is a space for Canada to make changes that will make the Americans happy without causing significant disruption to the Canadian dairy industry.
Okay, can you explain a little bit more about how Canada has administered it and what the U.S. doesn't like about that?
So the Americans would like the quota to be able to go to the highest bidder. They want to be able to try and find the highest value, the best opportunity for U.S. exporters. And what Canada chooses to do is to allocate those quotas to those that are involved in the dairy industry. It's not necessarily a unique or novel arrangement. And again, the dispute settlement panel said that Canada is doing what it's allowed to do under the agreement.
Okay, so basically, Canada's giving the license in Canada to import American product, but they're giving licenses to people who might not need that much American product, therefore sort of putting a limiting effect on the American exports into Canada. Does the U.S. often surpass its dairy export quota for Canada at all?
No, it doesn't. And the U.S. does have a legitimate argument in that they are not fully filling their quota today. They tend to underfill. They tend to be a little bit lower than what the full amount is. So Canada has made some changes, is trying to fix that amount. But at the end of the day, the U.S. has a legitimate argument that they're not reaching their full quota. We don't ever see over quota fill. Our tariffs are quite high. The U.S. president often gets the amounts wrong, but we do have high tariffs that are a barrier to that over quota trade.
Which is something like 200%, isn't it?
That's right. Some of it goes up to 300%, but the president at times has said we have 400% tariffs. And again, the facts aren't always the president's strong suit.
Yeah. How much dairy does Canada actually send to the U.S.?
So we do export some dairy, and it's important to know that 2024 was a record year for dairy production in Canada. So we talk a lot about the impact of these increased imports from the United States, but we are producing more dairy products. Canada's consuming more dairy products. That's the nature of a growing population that are interested in butter and other products. But we are exporting more, but they are still exporting much more to us than we are to them. Our trade surplus, their trade surplus to us is growing, and that's a good sign that the agreement is giving the American dairy industry better access to Canada. They are taking advantage of it. There is a financial benefit to it. And the U.S. dairy industry doesn't want to see supply management come down. They like our protected higher value market. They just want better access to that higher value market where possible.
Can you explain the supply management system and why it was built? I don't think a lot of Canadians understand why it was created in the first place.
The system was really created to give Canadian dairy farmers and the Canadian dairy industry stability in the marketplace. Milk is one of these perishable products. You need to have a system that works well so it can get from farms to processors. There was a lot of volatility in the marketplace, disruptions in contracts. And so a system was built. The system's got three different legs to it. It's got production controls, so we only produce as much milk as our market needs. It's got import controls so that we don't have floods of foreign products coming into the marketplace. And it's got pricing controls that ensure that Canadian dairy farmers get a reasonable rate of return. It's a system that again, replicates what a lot of other countries do. As much as we think that the U.S. has got this great free trade in dairy products, it has very similar systems in place that limit production and that limit imports as well. Canada's just more transparent and explicit in how our system works.
Could you see a negotiation in dairy, opening up dairy a little bit more to America, for example, being part of the process to get relief for other sectors like steel and aluminum?
So I think if you look at what the U.S. trade representative is asking for and making changes to TRQ administration, I think that that's absolutely something I could see the Canadian government doing. Whether or not it needs to go further than that, I think becomes this very big political trade-off. I think we heard today the Prime Minister saying that steel and aluminum is going to get slid likely into the CUSMA renegotiation rather than a sectoral deal. I think that may change the nature of many different things, and it's too early to tell how much pressure that might put on dairy.
Yeah, it sounds like, as you said, all of it will be pushed into one big negotiation. Tyler, I'm going to leave it there. Thank you for your time.
Thank you for having me.
Coming up, we'll have a look at hot picks in energy infrastructure, including one company that generates 400 megawatts of power for Meta's data centers. Back in a moment. Time now for hot picks in AI energy infrastructure. We were joined by Matt Salley, Executive Vice President, Head of Investments at Tortoise Capital. And we kick things off with Williams Companies as his top pick. He says it generates 400 megawatts of power for Meta's data centers.
The key is to get electricity as soon as possible. It's a race for speed to market to power your data center. And they're using, this is very interesting, it's the same generation they use to push gasoline through, or excuse me, push natural gas through their pipelines. Mm-hmm. They can put on data centers and bring power to these data centers within a matter of less than a year. And they're earning fantastic returns, 5 times multiples for fixed price contracts, fixed rate and fixed volumes. And here's the beauty of it: the same these generations use the same. They're using the same pipelines to basically it fills up their pipelines to run gas through them. So it's a double benefit. It keeps their pipelines full, and they're earning nice returns on these projects.
It's interesting. A yield of about 3.4% on Williams, another attraction here. Targa Resources, tell us what they do. What has caught your eye here?
So they're one of the key players in the Permian Basin, which is one of the most prolific basins in basically the entire world. They have pipelines running all the way from the Permian Basin to the Gulf Coast to get to the water, and they can export product. So they're basically a start to finish solution for producers. And Exxon came out last week and said that they are expecting now to produce 2.5 million barrels per day by 2030, which is up quite a bit. And that's Targa's biggest customer. So pretty exciting for them, and basically locks in their growth prospects.
It's amazing, isn't it, how the hydrocarbon industry has become fueled by AI enthusiasm here?
It is pretty interesting, and the amount of, in particular, natural gas that's going to be needed to produce the power. So basically, you probably know this, but over the last 20 years, at least in the United States, the demand for electricity has not really grown. Looking forward, it's supposed to grow 3 to 4% per year, which may not sound very exciting, but for electricity, that's a big deal. How do we produce that electricity? Nuclear is going to help out, but really it's a function of natural gas. So the amount of natural gas turbines being built, just phenomenal. You have companies like GE Vernova now that are sold out for, the next 5 years for their capacity. So the amount of natural gas that's going to be required to meet the power demand from AI is stunning, frankly.
And then finally, Cipher Mining, CIFR, what do they do, and what's the upside here?
Good question. Most people haven't heard of Cipher Mining. So they're a Bitcoin miner. Bitcoin miners obviously have been around for a long time. They procured power years ago to produce Bitcoin, but now what they're doing is transitioning that power. Again, it's all about speed to market to get electricity. They are turning that power into the ability to resell long-term contracts on high-performance compute. So they're locking up contracts with some of the hyperscalers, which in our view is going to allow the company to completely re-rate. Their growth is absolutely massive. It's off its highs quite a bit. I mean, it's up still decently for the year, but off its highs quite a bit. And we see really bright prospects for them.
Why has it come off its high? I know some of the AI-related stocks are down. Meta's off its record high as well.
It's all about the concerns about an AI bubble, which I think is, we don't think that's the case. I think there's certain pockets that are a little inflated, but pretty much anything AI or AI infrastructure related has come off a fair bit since its highs. Again, they've still performed really well for the year, but the growth prospects here are just phenomenal.
Matt Sallee, Executive Vice President, Head of Investments at Tortoise Capital. The Prime Minister hosting a virtual First Ministers meeting today, the first since he signed that Memorandum of Understanding with Alberta on pipelines. Let's go to CTV's Jeremy Chiron for more on that. Jeremy, how significant is the meeting today?
Yeah, Marilla, this is an important meeting, a chance for the Prime Minister to check in with the premiers, keep them updated on progress when it comes to trade relationships, when it comes to negotiations or lack thereof with the U.S. This is a pledge the Prime Minister made early on in his mandate, is to continue to meet with the premiers, keep them updated on things that the federal government is doing that the premiers are interested in, of course. And so this will be a virtual meeting. Premier Doug Ford from Ontario is attending in person, but the rest of the premiers are taking part in this meeting virtually. Prime Minister's office has made it clear they have some priorities here. They want to focus, number one, on talking about international trade, specifically between Canada and the U.S., but also more broadly in relationships that Canada is looking to build with other countries. The Prime Minister has done a lot of travel. He's met with world leaders. He's looking to bolster relationships with other countries in the face of a trade war with Donald Trump. And so he'll be presumably filling the premiers in on progress that is being made on that front. And there'll be a lot of talk, understandably, about the relationship between Canada and the U.S. Negotiations have been off between Canada and the U.S. since October, when Premier Doug Ford launched that anti-tariff ad that featured Ronald Reagan. Donald Trump didn't like it. He called off talks between Canada and the U.S. The Prime Minister today made it clear he felt Canada was making good progress. He felt perhaps potentially a deal on sectoral tariffs was close, but then that ultimately that ad that Ontario launched resulted in the end of negotiations and the fact that we don't have a deal. Premier Doug Ford stood by the ad today. He called it, a successful ad. He talked about how many views it got, while behind him, the Prime Minister, made it clear through his visual expressions that he perhaps didn't feel the same way. So I would expect that that'll be, a part of the conversation today. What has led to them getting here between Canada and the U.S. in relations, and how do they move forward? And the fact that CUSMA's up for renegotiation early next year. So there's going to be a lot on the table here in this meeting. And the premiers are all going to have their own priorities as well. We just talked about what the Prime Minister is focused on. The premiers all have their own priorities. I think we can expect that the Memorandum of Understanding between Alberta and Ottawa is going to be a big topic of conversation, of course. It's the first time the premiers meet since that deal was signed. BC's Premier, David Eby, is against it. He's taking part in this meeting, too. So lots on this list, an important meeting between the Prime Minister and all of the premiers here. Marella?
All right, one to watch. Thank you, Jeremy. We got second quarter results from Nike today after the bell. The retailer posted weakness in China and its Converse brand, sending shares down and offsetting the revenue beat for them in the second quarter. FedEx also reporting after the end of the trading day, raising the low end of a full year profit and sales outlook, signaling the company's efforts to slash costs and also streamline delivery networks are bearing some fruit. And FedEx, as you can see, up in after hours trading. Thanks for joining us today on The Close. We'll see you back here again tomorrow.